Welcome to LPA, Logical Price Action, the complete course, Session 4, the 3 Universal Laws. And we start off with the 3 laws, and this is today's agenda. The law of supply and demand, the law of cause and effect, and the law of effort versus result. Although only 3 laws, there is a great deal of information to go through here today. So before we begin, let's recap. So thus far, we have covered structure, which frames price, the roadmap. Then we went on to basic price action, where we were able to determine the strength of buying and selling. Buying of good quality, selling of poor quality. For example, we're pushing up here. We know the spreads have declined. And if we have volume and we can see the volume decline, this we would know as buying of poor quality. Or if we come down with increasing spreads and volume increasing, this is selling of good quality. And we will be able to determine the strength of buying or selling of poor quality just for mere price bars. And we've also covered turning points via shortening of the thrust in successive bars, closes and the extremes, a clustering of closes, which is price rejection in the current trend, etc. And last session we included volume into analysis. That confirms the strength or weakness via the price action, where we can gauge the force. And we're looking for follow-through, etc. Now we will look into 3 universal laws, and these are the governing laws of Wyckoff. They're very simple, completely logical, yet very powerful. So we begin with the law of supply and demand. A very basic, simple law, but this must be understood with 100% clarity, as this is the cornerstone of our whole trading methodology, as we look for the imbalance. Every bar on the chart, irrespective of time frame, represents a battle between buyers, demand, and sellers, supply. We know, we've already covered, a neutral bar, both buyers and sellers, no one won. A down bar, sellers won. An up bar, buyers won. So when demand, the buying, is greater than supply, prices will rise. And when the supply, selling, is greater than the demand, prices will fall. It's very simple, but as previously said, we look for the imbalance between the forces of demand and supply. If buyers are in control, as in the force is strong, and we recognize the behavior, whilst being able to read the chart effectively, we can look for long plays, and vice versa for a bearish tone. If sellers are in control, we can look for short plays. Everything else is just a tool. Springs, up thrust, 2-bar, reversals, climactic bars, shortening of the thrust, no demands, cluster of closes, etc. They are tools we have at our disposal to help us gauge the imbalance between the forces. When one becomes competent, we can find the turning points in the markets we trade. Many Wyckoffs use an excerpt from Wyckoff's book that I too must share, as it is profoundly important. Let me read this for you. Successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. There are critical points which occur in each swing, just as in the life of a business or an individual. At these junctures, it seems as though a feather's weight on either side would determine the immediate critical trend. So what does this mean? How does this passage help us? You're probably thinking, well, this is my interpretation. We study the forces of demand and supply to determine who is in control, the pulling power, and have belief, which is courage, in one's analysis and execute in the direction of the force. This is very, very important that Wyckoff mentioned courage. Self-confidence and belief are harder skills to develop than the mere analysis part of trading. This whole course, we will study and we will become experts, if you apply the knowledge, in the technical analysis side of being a trader. Self-confidence and belief that help you pull the trigger to enable positions is much, much more difficult. We can't really teach these, but one does gain skills through experience, knowledge, and of course, practice. And the feather's weight is the turning point. And this is where the balance is shifted from one force to the other. From the sellers to the buyers. And there will be an action, either a bar or a combination of bars, that can illustrate this concept nicely. For example, we could be in a downtrend where we see shortening of the thrust, where supply diminishes, or we may get some clustering of closes, where lower prices are being rejected, ergo potential buying. And say we hold here, and we have support and we spring, where demand proves itself, followed by a test of a spring. We will cover tests at some point, so you can come back to this, but please stick with me. A test is a low volume, narrow spread closing near the lows or mid bar. And this is what I would call the feather's weight within the turning point. This bar indicates the lack of supply. There's no more selling force. So the imbalance, the feather's weight, is the test bar. It has tipped the scales. We disconfirm supply on this bar. And that's how I like to interpret the passage. At these junctures, it seems though a feather's weight on either side would determine the immediate critical trend. So something so insignificant, like a very small test bar, is the critical point within the whole move. So if we're coming down, shortening of the thrust indicates supply energy is waning or decreasing, or clustering at closes where lower prices are being rejected. We have demand emerge via a spring, but not in control. Then the little test bar means there is no more selling force. Supply has evaporated, it's gone. So if there's no more selling force with demand emerging, and we have the lack of selling in the background, that's what shortening of a thrust illustrates, our test bar is the turning point. Therefore, we should go up. One could argue that the spring is the turning point, and it is. However, it isn't a feather's weight. The test bar is something so small, insignificant. The test bar disconfirms supply in the mildest way after we have seen supply dry up, demand emerge, and then prove itself via the spring. So the test bar is contextually correct. Of course, we don't have to take the passage so literally, but that's the way I like to think and trade. And here you can literally visualize the imbalance, the turning point, the feather's weight. I may have lost you at some point now, but once you complete the course and you have a thorough understanding of price bars, no supply bars, and test bars and springs, come back to this. I urge you to come back to this, and this passage will become very potent. You will extract a great deal of knowledge from that passage. Really is powerful stuff. We are always looking, analysing, studying the force of buying and selling, demand and supply within the market. When we get a read of an imbalance, we look to structure to lean against and price action to enter. For example, this is resistance. When we approach resistance with narrow spreads and weak volume. So this we would consider poor buying. And then if we see supply emerge, good down bars like this, say an up thrust or other, the 2-bar reversal, we note an imbalance. Why? Because sellers are active and the buying is poor. And we're using structure to lean against. And this is where this action occurs. And this is how we trade. This is, in a nutshell, all we do. Of course, it's never this easy. Occasionally the reads can be ambiguous. They're complex and require a higher skill level of chart reading ability. And on occasion, if we do manage to obtain a clean read, we may decide not to enter due to other factors such as risk or exposure, risk reward, if you think in those terms, account size, structural influence above and below us, imminent data releases. I mean, you can trade at data releases, and that's how I started my trading career, trading the German Bund, which is an interest rate derivative. I did that for a prop firm using Market Profile way before I found the methodology we have before us. And the firm changed its strategies. My new focus became the S&P, where Market Profile was not as effective. Personally, I prefer tighter contracts to use Market Profile, and the new methods in place, they didn't make sense to me. They were literally mere candlestick patterns and poor breakout strategies, and consequently I left and then spent the next few years developing my skills and the trading methodology we have before us that we're working through. Anyhow, tangent over. I can't really give you more examples of the law of demand and supply. Literally, that passage is everything we need to know. We're looking for the imbalance by studying the force, which is demand and supply, the buyers or sellers, and we look to see who is in control. And on occasion, we can read the critical points and make a play, like the test bar in my example after a spring, which was our feather's weight. Now, this is an important thing. The feather's weight can come in many forms, as the market can turn in any which way it wants. What do I mean? Well, we've already covered 3 ways of how a market can turn. We can turn from shortening of the thrust, clustering closes, or swelling volume. And within some of these examples, we won't have a test bar like from the spring. Okay, the feather's weight will prove itself in a different manner. And of course, occasionally, the market is nice and does provide us a clean story and concepts or principles to work with. Today, there will be a great deal of theory, along with many chart studies. Please bear with me. There is a lot of information to go through today. And if you have any questions, please feel free to ask questions at the end of each section or email me, and I should get back to you hopefully within a couple of days. Excellent. Let's go on to our next study, the law of cause and effect.